be making decisions when you're rushed and stressed. So the more that you can think about, how your later years look, what you should do, should you stay in your home, should you move to a community, the better off you'll be. And the more you make your adult children aware of that too, it really is very helpful and less stressful for everybody.
So I think the key here, Lydia, is that our guest today, we thought as far as being proactive, that this topic kind of falls into that category, Linda, and I'm sure you would probably agree to that. And you have extreme expertise in this topic. So we wanted to ask you about specifically the 55 plus tax filers. Do they get any kind of break if they decide they want to sell their house and move to a 55 plus community or other type housing option?
Yep. So there is a lot of information that's going to be coming, through this presentation. And I think it's important to make sure people perhaps go back to the first one to understand the continuum of care and why are we talking about Section 121? Because there is, when you make a balance sheet of your assets, for most of my clients, one of their biggest assets is their house or even a second house. And the idea of tapping the equity to transition to a continuing care retirement community like Beaumont, there are things about selling the house that you need to understand before you do the sale so that you really maximize what we call Section 121. So Section 121 is part of an internal revenue code. That's just a set of laws that were passed, and they focus on what happens when you sell a primary residence. And that sounds so simple, but when you start looking at how people structure their real estate ownership and how many people have second houses and other complications, it really can be tricky. So today we're going to go over these rules and this information at a very high level. And so the disclaimer and the suggestion is that when you hear things that might apply to you, you need to contact your CPA, your tax preparer, so that you get really good counseling. You need to hit bullseyes when you're structuring your planning for income tax planning. And income tax planning is something beyond the sale of the real estate, but because real estate is typically one of the biggest assets, you don't want to make mistakes. So when we think about moving to Beaumont or any other continuing care retirement community or moving into any other particular type of residence, you're looking at the income tax. And the question is does somebody who's 55 years of age or older get a special break? And when the law, Section 121, was actually updated decades ago, they actually removed the requirement that somebody be age 55. So it's not a requirement that you have a particular age in order to use Section 121. The idea is that there is a very simple rule under the Internal Revenue Code that says if you actually meet the use and occupancy test requirements, that you get to exclude gain of up to $500,000. Well, let's unpack that a little bit. If we don't like paying income taxes, when you sell a piece of real estate and it's used as your primary residence for 2 out of the last 5 years, and you're a single person, you get to exclude up to $250,000, $250,000 worth of taxes. And if you're married, filing joint returns, then you get to exclude up to $500,000 of gain. You get to avoid having to recognize gain on that profit. So if you own a house, like some of my clients will come in and they've purchased it, decades ago for $50,000, and then the house is now worth $200,000. That $200,000 of profit is what we're talking about. If you get to use Section 121 of the Internal Revenue Code, you get the check from the settlement table, and there's no income tax bill due. And so what is, the proper use? What is the proper ownership test? It can sometimes be very simple or sometimes very tricky. So when we think about the basic rule, for most of my clients, they've lived in one place for more than 5 years, certainly more than 2 years. So they meet the 5-year ownership and they have more than 2 years of use in a particular primary residence, and then they will be able to sell that property and exclude a significant amount of gain. So when you think about some of the subtle issues, so what is Section 121? It's nothing more than a part of the Internal Revenue Code that says, you know what, you really get to do some tax planning here and exclude a lot of gain. How do you obtain the Section 121 exclusion, and what are the ownership and use tests? Well, the ownership is whose name is on the deed. And the idea is that if it's a single person, it's pretty straightforward. But what if it's a married person? And we'll talk in a minute about what happens if the deed is actually in both a husband and wife, but maybe only one of the spouses use it. So as a little bit of a case study, we'll go over that and talk about that. So you can already see the use and ownership is just not always so straightforward. Sort of focusing back on, just to clarify, there is no requirement that you be 55 years of age or older, and there's no limitation on how many times you can use the Section 121 exclusion. So the idea of having to be over age 55 and you get your one-time exclusion is very much a misunderstanding. And the idea is that Section 121 does have anti-flipping requirements, so that if you do have a 2-year use requirements that you've met, that you can't do another flip until you've actually had another 2 years extend. So is there a limit in the number? Not as a one-time only, but there certain is an overlay to prevent people from doing this, every single year.
Linda, I'd like to talk about a personal use of this Section 121, which, again, those on the call, maybe it's not for everyone, but I've actually done this. I'm on my 3rd move now, so I've lived in these houses for 2+ years. My wonderful wife is willing to accept moving moving a lot, but it's a great tax planning opportunity, and it's a way to build a lot of wealth actually by doing that.
Right. And so your question about what if you already own another home and how do you plan to retire to that location? That actually speaks to how to determine your primary residence. Section 121 is going to apply to your primary residence. You're using a home as your residence. So if you are moving from one place to another, as with seasons and different things, and you sell a piece of your portfolio, one of the pieces of the of the real estate, the Internal Revenue Code says, how do we figure out if this Pennsylvania property or the Florida property, which one was actually your primary residence? And so what happens is that you look at the facts and circumstances to see if you meet an analysis based on the past 5 years. Where did you spend the majority of your time? So the fact that you own 2 properties doesn't mean you can't have a primary residence. It just means that the Internal Revenue Service is going to look to see, okay, if you sold a property and you're claiming this exemption, then they may say, if there's an audit, which may or may not be likely, but if there is an audit, they'll say, okay, tell us, where did you spend the majority of your time? And going back over the past 5 years, it's possible that you have within the past 5 years that you lived in one home for 2 years and another home in 2 years. It's possible that technically you could have had 2 primary residences, but you're selling one of them. And so when you look back the 5 years from the date of the sale, the question is, what do your tax returns show? What does your banking relationship show? Where does the rest of your family live? Where did you, if you attended church, where were you actually sort of setting roots? And so there is a potential analysis if there's a question about what's your primary residence, but usually the documentation, if you're getting good counseling, and sounds like if you're using this idea of using Section 121, you're being very careful to probably change the records on your tax returns, your driver's license, your bank records.
Where
so
you
that
vote, absolutely.
Where you vote. And
Yeah.
so if you're going to actually do this, you're getting counseling from the CPA in advance so that you are actually setting yourself up for success. Okay. And the Internal Revenue Code and the regulations absolutely lay the framework for good planning so that, Brett, what you're doing is actually a very sophisticated tax strategy and something that says every time you make a profit of up to perhaps $500,000 because you're married, that profit is not subject to any income tax. So if you want to build wealth, what you're hearing in the audience is that this is something that instead of focusing on a primary residence, like most of my clients, where you move in, raise your family, and go out feet first, the idea is that, wait a minute, Lydia's saying, perhaps your proactive planning should suggest that you don't want to wait to go out feet first. And number two, if you're trying to build wealth at a time when things are very, you understand where your primary residence is, this may feel like a very conservative approach to build wealth.
And Linda, what about the case where we have clients that own properties in, let's just say, 3 locations. Let's say they have one in the Delaware Valley, then they typically would have maybe a place somewhere in Florida, and then the Jersey Shore, right? And
Right.
maybe they're leaving the Delaware Valley and they're going to move initially to Florida and switch and sell the Pennsylvania property and decide, let's go to Florida and live there for a couple of years. Is that a typical strategy? Do you see that happening as a way to bail out gains from these various properties and sell each one of them?
Yeah. And the idea is that you sell Pennsylvania first and you apply that, the rule, the use and the ownership. Did you use it for the past 5 years, for at least 2 years as your primary residence? And it doesn't have to be consecutive 24 months. And the idea is that, yes, you meet that in Pennsylvania. If you go down to Florida and then all of a sudden establish through your bank accounts, your voting and things like that, that you've used that as your primary residence, you may perhaps decide you want to get a bigger residence down in Florida. You'd have to actually think about the anti-flipping part, which is you're not going to be able to do that just immediately. You have to be very careful, talk to your CPA, and make sure you meet the 2-year requirements.
Linda, I have a question. You just said about if the 2 years doesn't have to be consecutive.
Yep. So when you think about somebody that may actually have multiple residences and you look back 5 years, people may actually have spent the majority of the time, based on the facts and circumstances, they may have been in Pennsylvania 1 year, Florida 2 years. They went back to Pennsylvania because one of the spouses were ill. They spent 2 or 3 years there. It's very specific to the facts. And the fact is that the 1 year with another 1 year that's not continuous can actually still meet the 2-year requirement.
Interesting. Okay, I didn't know.
So it's that collection. What I'm hearing is you need to be somewhere for a collection of 2 years. Is that what I'm hearing?
That's right. And when you're looking at this under the facts and circumstances test, most people aren't going to be looking at temporary absences due to health as part of this equation. You're actually structuring these things, I think, and making sure that you're meeting the requirements. But it just goes to show you how really flexible these things can be. But you're also, much more flexible. So the first question, what if you work part-time in your home and claim the home office on your tax return? What that question's really asking about is depreciation. And so when you think about what happens when you have a different type of property, business property, the IRS acknowledges that that business property may actually go down in value every year simply because you're using it, and you get a wonderful deduction called depreciation. And so the great news is you get that deduction. The bad news is that if you just sell that property, then when you get your check from the buyer, all of that money is going to be treated as ordinary income, not even capital gains, but as ordinary income. Capital gains is going to have a particular rate that's sort of capped at a certain number, like 20%. So when you think about depreciation, again, you are going to have a CPA that's sort of counseling you. And if they are looking at the use of your house, partial use of your house, as something that might actually trigger some deductions, then you have to be careful to figure out, is the use of the primary residence as a business property, how will that affect the gains? And so your CPA will be able to tell you, well, if you're a single person and you sell your home and you've taken some deductions for the use of the property for business, how will that affect whether you get, if you sell the property for a whole $250,000, it may be that the value of the house that was sold, they may apply a factor to it so that it's not treated as the whole sale proceeds being something that's recovered in the sale of a primary residence. So this is actually a really very interesting question, and again, gives you an opportunity to think about if your income tax planning up to this point has included depreciation, your CPA is going to be your best friend in figuring out, okay, is the Section 121 going to be available to you with some proactive planning? And if not, then what is the income tax cost that's going to be used? And when this is way beyond the scope of this presentation today, but when you think about additional sophisticated income tax planning, certain people will have commercial real estate and do what are called tax 31 exchanges, or there have been 1034 conversions. Those things are way beyond my level of expertise, and I don't do that type of planning. But this income tax planning, the concept of income tax planning, is really where you have to focus how to build wealth, because for when people die, most of them, unless they have an excess of, millions and millions of dollars, are not going to have exposure on death taxes or inheritance taxes. It's the income tax, area that really can reduce the size of their nest egg or long-term care expenses. So your question was, well, what if you work part-time in your home and claim that on your return? The idea is for anybody that has any particular deductions, including depreciation, talk to your CPA before you list the house for sale.
Got it. That's good advice. I like that. And then we see a lot of clients where they buy the property together, so the deed has two names on it, and then something happens to one, and is there any what happens? Is there like any time stipulation where is it based on filing of your tax return to get the difference between the $500,000 and the $250,000 exemption when maybe only one spouse is alive at the time?
So I looked at this question completely differently, but I think what you're saying is when you look at the use and occupancy requirements and one spouse dies, what happens when that single person continues to live in that primary residence? So if a spouse is recently widowed, the Internal Revenue Code is very generous and recognizes that this is something that we shouldn't penalize that surviving spouse. And under the Section 121, there is some relief in that you can actually continue to claim the $500,000 married person exemption for a period of time. So what I would say is that if you have a deed that appears to have joint owners, or the deed is in a single person's name, but they actually had a married couple living there, talk to your tax preparer, because there are relief valves that will help that surviving spouse to actually get potentially the $500,000 and not be limited to the $250,000 exemption. When I looked at this question,
Sorry.
I looked at this as one of the situations that will frequently come across my desk, which is that what happens when an owner of real estate dies to the income tax issues that are built in the real estate. So every once in a while, I will have a parent come in and said, you know what, I was never going to let my house be taken by a nursing home, so I just sold it to my daughter for $1. Okay. And so when I looked at this question, I was thinking, oh my gosh, this is exactly what this speaks to, the problem that people don't realize, which is, unfortunately, there is incredible income tax planning to be done by owning real estate when at the moment you die. So if we have a daughter who was given the house the day before mom died,
Oh,
and it was
gosh.
worth $100,000, for instance, we'll keep the number simple, right? That daughter will have inheritance tax because the gift occurred within 1 year, and the inheritance tax will be 4.5% of $100,000, $4,500, not horrible. But what's worse about this is that if mom bought the property for $10,000
Oh,
and we
gosh.
sell it
Yeah.
for $100,000,
It's
they have set themselves up now for a $90,000 gain. And that gain is not going to be excluded because the daughter didn't own the property and she didn't use the property to conform with Section 121. She didn't actually meet Section 121. So if she sells it the day after mom died, she gets a $90,000 paycheck. Now,
Oh.
if you compare it with, again, just to illustrate the difference, if the daughter comes in and says, my mother died yesterday and I'm going to settlement today, well, the value of the property is measured now because mom has passed away at $100,000
Oof.
for purposes of determining gain by the beneficiaries. So in that case, it's horrible because, the parent has passed away, but at the same time, there's a switch out from the basis that the mom had, and that's the official term, the cost basis of the property no longer measures the gain. It's used on the date of death value. And so many parents will come in and say, wasn't I good to do this? Only not realizing that they've just given their adult children an income tax bill. And the bottom line is that those things can be cured. So what we will say to mom is, let's get a deed putting the property back in your name, and you are going to meet the Section 121 exclusion tests. Not to worry, the deed doesn't actually, the ping pong effect doesn't harm the Section 121. And if you're concerned about a nursing home taking your home, well, the solution is to put the real estate into what's called an irrevocable trust. It's irrevocable because you don't keep control, but the daughter as a trustee has a substantial amount of control. And the Internal Revenue Code has given us a gift by saying expressly that if this trust is structured as what's called a grantor trust, even though mom has given away, quote unquote, the property, the trust is treated as mom for Section 121. And you get the $250,000 exclusion during her life. And the trust can be designed to get that stepped up basis to the date of death value. I have to be careful in going right into the weeds for everybody. But the bottom line is your question was, what about beneficiaries trying to make sure that they sell real estate properly? And the first thing to understand is death is a tax planning opportunity, and that nothing is simple when you're changing the ownership of your real estate. Direct gifts to children can really harm you if they pass away first, if they have divorces, if they have their own creditor claims, in addition to losing the opportunity for that stepped up basis. And we can do better because we have a revocable trust.
And
Okay.
Linda, I'd like to give you a special accolade because on the earlier call you were on, there was somebody on that call, and I don't know if I ever followed up with you, but said how grateful they were because you did alluded to that under a prior webinar.
Yeah.
And that's like so important for people on this call to know, like that's just a huge opportunity to being proactive and to plan in advance and to seek your services well in advance, just so that you don't run afoul of Section 121.
Right. You don't want to miss the opportunities.
Well, and it also goes to how complicated all this and getting professional advice so you're careful. And
yeah. Oh, it's amazing to me how many people will go get a deed done somewhere and just then think, okay, then I'll go into meet with Linda, and only to have to give them this really disappointing news. And I don't want to scare them because I can fix pretty much all of it. It's just, again, nothing's ever simple.
Right. You're right.
Nothing. Yeah.
And then I had another question, which I was thinking, I hope I'm going to try to simplify the question. And that is, we talk about this gain, this 250,000 or 500,000 if it's a joint tax filer. Does the whole thing based on the original purchase price of the property? Let's assume the joint tax filer bought the property in 1980 for $25,000, but along the way they've put a lot of money into the property. They fixed up the kitchen, maybe they added a family room, and they put additional money. My understanding is they get credit for that, meaning the gain they're going to calculate to figure out if they're exempt is they're going to take a look at the original cost of the property. You can add all your improvements to it, and then you would subtract your selling price. Is that simplified enough? And does that sound right?
Yeah. So the idea is that when you have this concept of the cost basis, the original purchase price, that can actually be increased because of the capital improvements that you're doing. And capital improvements, the Internal Revenue Service thinks, okay, not everything's a capital improvement.
Right.
Certain things are just maintenance. You paint something a different color, or you buy some different light fixtures. They may not think of that, as a capital improvement, but if you add on, or do really significant things to the property, those are things that can increase that basis number. Yeah, absolutely.
So it's important then, I'm assuming, Linda, then to just keep good records along the way as well. I mean, if
Yes. Yes. Yep. And so what happens is that, if there are no good records, again, just understanding that when somebody dies, you're pushing the reset button so that that date of death value becomes your basis. And it may be, different than whatever the purchase price and the capital improvements are. And I guess it's possible you could have a lower date of death value, but the bottom line is that number becomes your new number, the date of death.
And another thing I was thinking about, Linda, when you mentioned how so many people just decide, without proper counsel, they decide they're going to change the ownership structure and give the property to their daughter or son or whatnot without any type of counsel. And that can be a super costly mistake. So it seems like engaging someone like yourself early on in the process could pay like huge, gains to that client.
The idea is that for most people, this is their biggest asset and they look at it as part of a legacy, and they really don't want the next generation, because it's so hard to get launched, they don't want to have something take away from their legacy. And unfortunately, without getting any really good advice, you can have these strange inheritance tax results, income tax results, or even circumstances within the adult children's estate plan or problems that will affect you if you don't actually do things in a particular way. And so when you think about people that have high net worth, they're used to going to lawyers or accountants and getting advice. They're used to actually thinking through how to actually hit a bullseye, where people just don't appreciate how sophisticated things are. And so anytime you're dealing with your biggest assets, it's worth the investment to talk to your CPA or your lawyer just to make sure that you maximize all of the things that are real risks to you. And the real risks are loss of use and control and income tax and long-term care expenses. And there's a way to actually manage all of those risks. And that's what planning is to make a list of all the things you're worried about and then just knock off the worries one at a time.
And then
Planning
Linda,
and professional advice.
so this kind of dovetails into, and we talk about this in this whole, workshop series about advanced planning. What do you recommend, Linda, as the best, time? How far in advance do you think someone should plan? Those on the call, do you say when they hit 60? Should they be doing this at the age 45? Is there something you'd recommend?
So I think on the last event, if I didn't say this, I probably should have, but my kids, when they turned 18, got a set of documents, estate planning documents.
Okay.
And so the idea is that I actually have clients of all ages. And so when you think about what we worry about, the idea of income tax planning means that your financial power of attorney has to have some sophisticated language built into it. So if you don't even have a financial power of attorney, you're missing a huge piece of your estate plan. And an estate plan isn't for people that have millions and millions. It's for every single person age 18 and above. And then you would also want to make sure you're controlling your healthcare decisions. The idea is that, long-term care is expensive, and how you select the person that would help you select, a continuing care retirement community or perhaps arrange home health care. That person is critically important to making sure that you meet your care goals. And you also want to have an advance directive so that you don't get a lot of unnecessary medical treatment at end of life. And then, of course, you want to have a will or a living trust. Living trusts are great for people that have real estate outside of Pennsylvania. Living trusts are sometimes oversold in Pennsylvania. You don't necessarily have to have a living trust to avoid probate in every single circumstance. In some states, it is a bigger priority. But you're going to want to make sure when you finish this webinar to go and pull out the file with all of your documents and see if you have a will, financial power of attorney, healthcare power of attorney, living will. We also do HIPAA authorizations, and you want to make sure that those things are within, a recent amount of time. What I would say is that if they're more to 3 to 5 years in effect, that it's really time to have them be reviewed to make sure that you're keeping up with the changes in the law and things that could be changing in your circumstances. You may have some family members who've passed away or been born. You may have inherited money. You may have had a retirement. So there are things about stages of life that should be reflected in terms of your planning.
Well, I think I'm not seeing a lot of questions, which either this is such a complex topic. I mean,
Yep.
I think it's my favorite topic because I deal with this, every single day in my real estate practice, which is the sale of primary residence. And that's one of the things I always mention to people is like, how long you've been here and you get this great benefit. What I'm amazed about is that so many people that I talk to have no idea that this even exists. They think,
Right.
okay, we sell the property, how much, I'm gonna have to pay all these taxes. I'm like, you're not going to. You're going to get this huge, assuming you do this properly and correctly.
Right. So I think, when you think about this topic, this first impression for people that are actually listening to it now, they may not be teeing themselves up for a sale of real estate, but what we're really doing is saying you have to be able to issue spot. And that when it comes time, when you've actually thought about talking to Lydia or, moving to a different, proactively developing an aging plan, and you may actually be selling your property, then you have to sort of think about some of the subtle issues inside of Section 121. So why don't we spend just a minute or two just going through some of the really interesting subtle things. So I think we've talked about the fact that it's use and ownership, and that the ownership isn't where it gets tricky. You look at the deed, and short of having those unusual circumstances of passing it to a child and returning it, or using an irrevocable trust for great asset protection planning and centralized management, most of the time the use isn't going to be where you're trying to figure out if you meet the requirements. It's the not the ownership, it's the use that can be really tricky. So again, from an elder law point of view, there are special parts inside of Section 121 that may not apply to you now, but you'll just be able to spot them later on if it comes up. And again, the idea is that sometimes people, because of physical or mental incapacity and their needs for self-care, they actually have to move out of their home.
Right.
And so it's unfortunate if you have to be transitioned, because there's been a tipping point. And there is inside of Section 121 a really clear loophole to make sure that if you absolutely are out of your home, that time is actually still going to count towards the 2-year requirement. And so again, there are things about those types of transitions, or there's actually an unforeseen circumstance exemption, that if you ever have these quirky stories that end up on law school exams or across the CPA desk, those crazy, complicated questions. There was a recent tax court decision in April of this year that really focused on what is an unforeseen circumstance. And when I looked at the regulations and the decision, there's a lot of wiggle room here. And so your CPA, when they have these crazy fact patterns, may not be able to just guarantee the full $500,000 exemption, but they're certainly going to be able to explain to you how to get some of the proceeds under the excluded part. And we already talked about, so transitioning to a nursing home or a skilled nursing or continuing care retirement community, we've talked about that. What if a spouse dies? We did talk about that too. The idea is, again, the Internal Revenue Code has a very gentle hand when it talks about somebody who's lost a spouse, and there is some relief in there so that you get to actually in certain circumstances, get that whole $500,000, even though that spouse isn't there to have a signed joint tax return. There is a way for that exemption to be the full $500,000. We also talked about the idea of irrevocable trust planning. The idea is that many of my clients have never had a fancy irrevocable trust. But once they see what happens when somebody goes into a nursing home or if they die, they think, okay, now I really get it. And so it's hard because there's a learning curve for clients who've never had trust planning and for the adult children who have to be our trustees. But we have a little trust law school for them, and they get through the learning curve. And especially after the first year, things pretty much go on autopilot. And again, there are subtle issues about what happens if we have a married couple, but the use hasn't really aligned. Perhaps they are separated, or perhaps one of them uses one property versus the other. Again, those things are easily planned for, and you can still make sure that you're hitting the bullseye for the $500,000 if you understand the use requirement. That can be tricky, but also counseling for it can be used to make sure you get your benefit. And this non-qualified use. So there are people who live in a property and then rent it after they've moved out until they get their next property. They move out of state. And the Internal Revenue Code says, okay, well, you may still be treated as somebody who owned and used it for that initial, you look back 5 years and you disregard that non-qualified use. But there are other people who have income producing property or other property that they have used as a non-qualified use and then turn it into their residential property. And in those cases, you have to be very careful because there is a ratio that can be applied. And so what happens is, again, this is well beyond the scope, and you would never take this very high level analysis and try to do this on your own. But if you own a piece of property for 8 years, and out of the 8 years, you have 5 years where it was rental property and 3 years as primary residence, you're going to want to make sure that you get good counseling on how Section 121 will actually apply to that. And, again, there is a way to be counseled so that you maximize those deductions, not the deductions, the exemptions. And so you really want to be careful anytime you're moving from something that was a non-qualified use, it's not your primary residence, then making it into a primary residence. You actually have to get the game plan in place beforehand. And same thing, Brett, I think you already alluded to the idea of planning with a second home or third home,
Yes.
again, to be strategic and understand that this is your planning opportunity to really make sure that all the appreciation that you've gotten the benefit of, that you actually squeeze all of that out with good counseling. And so I think, again, this is not the kind of topic that everybody is going to be able to take and use immediately, other than going to make sure you review your documents and make sure they're still up to date. But the idea of issue spotting, knowing that there is a really significant tax cost if you don't do things right. And the idea is that nothing's ever simple, but you can get excellent counseling from your CPA to make sure you really do hit the bullseye.
Because a mistake in this case, can be quite costly if you don't
Yes.
get your
Yeah.
250,000 or 500,000 exemption. That's a huge mistake.
Right. And you won't feel so great about your appreciation and your investment when the tax bill comes, especially if you come to understand, like the adult children who come in afterwards having received their gifts, and for us to do an estate administration. And unfortunately, we sometimes have to tell them that they've lost the opportunity for that stepped up basis and that they're going to have income tax issues now.
That's a tough conversation to have, but I guess, you have to have that conversation
Well, I'll suggest to them, guess what? Maybe you want to live here as your primary residence.
for the next two.
Yeah. So let's just buckle down and just make sure we meet Section 121 with a little bit of planning for you in that way.
Well, in my case, on the Section 121, for, having moved now my third time, I found that the requirements are you need to have a super cooperative spouse, right? Because
Yes.
telling someone you're going to move every 2 years can be a little challenging, right? Because you have all
Yeah.
your stuff, what to do with it, and moving. But what I found is when you do move a bunch of times, you seem to get rid of a lot of the stuff that you no longer need anymore. So it's kind of uplifting in a sense.
You're a very impressive case example, Brett.
Yeah.
I have to tell you, for every one of you, there are 10 people that have everything in their home that they've ever owned. in the attic, the garage, the basement, and that it's precious to them and it's very hard to make a transition. So, that's where Lydia and your other team members and resources come into play. So but if you have to clean it out for one move, you might as well keep moving.
Right. Because the downsizing aspect is extremely challenging.
And for everyone on the call that maybe came in late, don't forget that in the beginning of the call, we talked about the concierge service. So if you need help with what to do with your stuff, Lydia, isn't that like the number one challenge people face is they get to the point of, I think it's time to move on, and people just get overwhelmed with all the stuff and what to do and where it goes and everything.
That's the word, overwhelmed. But
Yeah.
there are great services out there that can help. Anything from, estate organizations that can come in and give values on things to junk removers. I've had to do this, in a personal situation as well. And it was really organizing it from, what family members wanted, then having somebody come in from a, estate purpose and like what would sell at an estate sale versus a junk remover, quite honestly, because when you're in a home for 50 years, believe it or not, there's junk, even though you don't want to call it that. But yeah, and it is
Right.
overwhelming, and it's very overwhelming to the adult children to try to deal with it. But there are really great services. It's just a matter of education, like all of this is. It's educating yourself and planning.
Well, and I also think the junk or the valuable items and all of the things, the contents, that is part of the challenge of moving.
Oh,
There's
absolutely.
also the emotional transition that I think is really interesting. And because our law firm is an elder law firm that does life care planning, we have social workers as part of our staff. And I think what is interesting about the process is that it is a process. And so that I'm representing the parents most of the time, and they may be saying to me, I don't want to move. I don't want to leave my home. And my social workers may be saying, you know what, they are not safe without getting home health care, which they consider babysitting, and they're upset by that. At the same time, they need a protected environment. And so what I would say to the family members, whether you're the parent or the adult child, which is that this process is something that is not always a single conversation or a forced decision, but actually something that when you give people information and show them the path and give them options, the process, I think, in many times can actually be successfully navigated with a couple conversations. So for instance, I have a couple families right now who, if you looked at it completely objectively, they should be moving. Winter's coming, snow, bad weather, all of that. But the families are having conversations and saying, you know what, let's get through the holidays, but let's agree that when January comes, the new year comes, we're going to have a fresh start at a different place, because that's what we really need to have happen. And so what happens is the conversation, and our parents feel that they've got some control inside of that conversation and the process. And occasionally what happens between now and January is the medical conditions switch. And because you've already had that conversation, it's the next logical result is you're going to need more support. So it's not as if we're just sort of waiting for the crisis to happen, but preparing for the possible continuum of care and transitioning along the continuum of care. So that's a whole nother conversation, but it all relates to dealing with the primary residence and the contents and the tax code and then people's emotions.
Right. And you know what? I'm sorry, Brett.
No, go.
It's really that was a very good statement you made, but it is multiple conversations, or it should be, because it's that issue of control and the emotions involved in all this. And it can be very, very difficult to have those conversations, but it is so important, as the adult children, to really talk to parents, and for the parents to really think about, like, what does life look like in your elder years? But those conversations are so important. And sometimes you do need that social worker or geriatric care manager involved to help kind of guide that process.
And we did have, Linda, I don't know if you can see or not, but we did get a question that came in, and I'm just going to read it. It says, can the nursing home look back a number of years that would affect the irrevocable trust on the house?
Okay, so this is somebody who wants to know about Medicaid planning. And so if you're putting a home in an irrevocable trust, it can sometimes be for centralized management and control, but sometimes it's because people are really concerned that if they go into a skilled nursing facility and apply for Medicaid, that their home will be used to fund their care. And so if you put a piece of real estate or any other assets inside of an irrevocable trust and apply for Medicaid, Medicaid has a 60-month look back. That means from the date of the application, going back 60 months,
Okay.
they'll look to see what the value of the house was. And if it's $140,000 of value for the house, that's basically a 10-month transfer penalty that's floating, waiting during the 60 months to come back and bite you. If we're doing irrevocable trust planning, it's because we've analyzed what other assets are outside of the irrevocable trust to get us through that 10-month transfer penalty. If you get good counseling, the idea is that assets that you don't expect to need for your care can go into the irrevocable trust, and you're never applying for Medicaid unless you have actually structured a source to cover the 10-month penalty. So Medicaid planning is a whole nother hour, but the idea of using irrevocable trust for your primary residence is just one way to actually protect your home.
And then the next piece that I'd like to let everyone know about the call is certainly connect with us, stay in touch. We do a lot of really interesting things. Coming up will be our Pi Day giveaway and Thanksgiving. So those that have signed up for the webinars, workshops will be part of that. And then, although I just put this in as the question and answer, I didn't know if there were any other questions. We didn't get a lot of questions today, so I'm wondering, I'm not sure what that means, but I didn't see a lot of other questions. But I would say that I think everyone on the call, we will be sending out a survey because we like to know what kind of topics people would like to have in future events. And I'd also like to mention that who our next speaker is, which is really going to be an interesting one. We have Catherine Twitmeyer from Next Nest Advisors. She helps seniors transitions into their next home. So she's someone that can come in and kind of figure out what the right fit and match is for you, and she knows all the various facilities. She's been at every single one of them. She has clients in all of them, and it's going to be a really interesting one. So you can join us. It's October the 8th from 10 to 11. And Lydia, did you have any closing remarks or anything I missed?
I'll just say, I think it's excellent food for thought. And when you're saying, not a lot of questions, it's like, this is, just in my own mind, like this is a lot to digest and to think about. And I won't be surprised if, Linda, you have follow-up to this.
Yes.
Because again, it needs, this section 121 really has to be done carefully, and you really need professional advice. And I think it's like, I'm already starting to think, like when you mentioned, if you have a rental property or you have another home, like there's a lot to consider in this, but to make sure that you are planning and proceeding carefully.
And it also seems like many people kind of push this off or put it off, right? It's just something they don't want to focus on. But I'd like your earlier advice where your 18-year-olds got their planning kit. I think that's an awesome present so they can get started at an early age, because it seems like the sooner they get this process started, the better the outcome will be, right?
Yeah. And everybody who, finish this and make your homework, just checking out your own estate planning documents and make sure you've got really a good foundation.
Great advice.
Yeah, thank you. And I'm super grateful to have everybody on the call today. Again, we had a lot of people sign up, but what we told everybody on the call is if you weren't able to make today, we were going to be sending, we started the recording and we'll be sending copies to everybody on the call. So if you want to hear something again, it will probably go out sometime next week, as well as a survey. And we're grateful. If you have any other topics you'd like us to add, this is a building block we have on. If you go to our website, which is down here, you'll be able to access a lot of other resources we have specifically for the senior population from all of our guests, including Linda. I know you've given us a lot of information that we have on the site as well, but you can also get copies of prior recordings. And with that, I'd like to ask Linda, how would somebody get a hold of you? Because that's usually the question, right? They listen and they're like,
Yep.
I need help with section 121, or I need a will, or whatever they need. What's the best way to
Yep.
reach out to you?
We have clients throughout the Delaware Valley. We have 2 locations. Media is our primary one, and we're opening up another site in Westchester. We also do virtual work for clients in many other places. So where you can find us is on AndersonElderLaw.com. And if you have any questions and want to send them to me, my personal email is landerson@AndersonElderLaw.com. And I'm happy to follow up with any questions from today's presentation.
I don't think I didn't see any. Okay. We finished. Actually, we said we're going to go an hour. We're just like 4 minutes under, which is awesome. So I appreciate Linda, as always. I'm super grateful to have you on board. Lydia, what can I say? I mean, your background and your help has been awesome to help this series get going. And for those on the call, don't forget, we'll be meeting again next month on Saturday, October 8th. Everyone have a great Saturday. Enjoy the great weather, and we'll see you soon.
Thank you.
Thank you.